probably Latin America. You see, even at the end of 1990 and December 98, Asian financial crisis. Now, the good thing is that emerging economies like ourselves, after succumbing ourselves to each crisis, we learn from it. We build up reserves, right? And restructure our banks. Which is why, at this point in time, the question of whether emerging markets like ourselves can save the world or not doesn't arrive. It's more whether we can save ourselves or not. And I think we can. Because we have built massive reserves, we have restructured ourselves. And that is good enough. As long as we don't fall flat or as low as advanced economies like US and Europe, then the whole world is fine, is at a better footing than all of us collapse together. So, going forward, we expect rebalancing, we expect global rebalancing to continue taking place. We believe that the current account deficit in the US will shrink. Already, for the past 6 months, the US current account deficit has shrank by 1/3. Current account deficit means you are actually importing more than you are exporting. Currently, because of the crisis, US consumers are spending less because they have less money in the pocket. They can borrow less because credit is not available for them. And also, if you are seeing the funding of that, the purchase of US treasuries has come down. So, going forward, the issue is how much more of inflows will go into the US economy. And before I end my outlook on the global economy, I'd like to highlight that over the next 12 to 18 months, there will be some form of gradual reversal of easy monetary policy. Easy monetary policy means every central bank in this region and the whole world has been cutting rates or has been printing money, especially in the US and UK. Now, we think that there are four means in which global central banks would end, I wouldn't say end, but it's more like reversing gradually the easy monetary policy. Firstly, for crisis-hit major economies like the US, Eurozone, and UK, they will not be hiking rates anytime soon. However, because of concerns over future inflationary pressures, they may withdraw some of their liquidity support, being that in the US, for example, 1.45 trillion has been allocated to buy back mortgages. Will that end? We think so. We think over the next 12 to 18 months, if not shorter, they will pull back on these measures. That is for the US side. Now, interest rate hikes. Already you are seeing Australia hiking rates last week. Right? We think that non-recession economies like China and so on may embark on such measures. China, perhaps India as well, to control inflation. And of course, the other two quadrants are market-based instruments and regulatory measures. We think that there will be more mopping up of liquidity through issuance of short-term debt securities undertaken by the PBOC in China. And of course, finally, there will be regulatory measures to control asset price bubble, property prices, especially in Hong Kong. So, global market outlook. This page summarizes our outlook on the global economy and different asset classes. On the economic front, we are neutral. Financial markets seem to have priced in a recovery. The question here is that the recovery that we are seeing, is it sustainable going forward, or is it just because of the stimulus package that we have seen? Is it because of the interest rate cuts, the monetary policy loosening that we have seen, and also is it because of inventory correction? Now, bonds, we are actually positive to the surprise of most people, partly because of our view. We think that the V shape that we are seeing earlier is not sustainable, it's going to level off. So with that, interest rates will remain low for a prolonged period. And at the same time, if you are seeing a recovery, a tiny recovery, small baby steps, that will continue to be supportive of credits, right? Because when there is recovery, cash flows, corporate earnings will flow in, and that will be credit supportive. So which is why we are actually positive on fixed income. Interest rates outlook, needless to say, we think that rates are going to remain low for a prolonged period, owing to the fact that global recovery remains anemic. And foreign exchange, we are of course negative on US dollars on a long-term secular trend basis. However, on a short-term cyclical time frame, we think that there might be bumps, there may be blips. dollar could regain some strength because of flight to quality, that's one. And second thing is, don't forget, we are looking at twin deficit of 13%. Twin deficit means current account deficit plus the ballooning fiscal deficit. But because of the fact that the US current account deficit has come down by 1/3, that itself is in a way supportive of dollars because US consumers are importing less now compared to before. So essentially, this summarizes our views. The next slide here shows whether bonds and stocks can coexist. Okay. Now, many months ago, people always say that if bond goes up, stock will go down, or if stock goes up, bonds will come down, right? So the key is that may be true, but in only one of these quadrants. Now, in a downturn, which is what we saw in the second half of 2007 until 2008, you have everything coming down. You have equity prices tumbling. You have bonds, corporate bonds coming down because credit spreads widen. Okay? Why credit spreads widen? Is because when there is weakness in the market, people perceive the creditworthiness of corporate bonds to be deteriorating. Now that was in a downturn. Now we have a repair, okay, that is in the first half of this year. Well, because of all those stimulus measures taken by the government, because of some support to the consumer sector, corporate profits have been better than expected. Hence, cash flows are also better, which is why credit actually outperformed. Corporate bonds are doing very, very well, not only in Malaysia, but in Asia as well. Now, the next is recovery. We are moving from a repair to a recovery cycle. Okay? In a recovery cycle, you definitely see both equity and credit are being supported. Okay? Because of the fact that earnings are growing stronger. Right? So we are in these two phases now, repair and recovery, which is why we think that bond would remain supportive. We think that bond would remain positive because of the fact that there is some positive earnings and also recovery to the prospects of corporate earnings as well. Of course, in the late expansionary cycle, equity is better than credit. Okay, that is why the reason being that leverage will increase and corporate activities become more speculative. But we are far from being at this phase here. We are far from being expansionary. We are in between repair and recovery. So we think that bond market, corporate bonds would remain positive because of this reason. Okay, I'll now move on to derivatives, structured investments. Now, structured products are actually what we call as 100% principal protected products. If they're structured in such a way, some may be 90% protected. Now, their potential returns are actually linked to multiple strategies. It can be linked to equities, commodities, fixed income, foreign exchange, or multi-asset. Right? Now, they can be issued in Malaysia in several forms. One is as FRNID, floating rate negotiable instrument of deposits. And they are in multiples of 100,000 ringgit for conventional and 50,000 ringgit for Islamic FRNID. Of course, the other category is structured products issued under Securities Commission guidelines. The third is structured unit trusts, in which a minimum size of 5,000 investors can then put their money and invest in these kind of instruments. And of course, insurance companies also issue their own capital protected investment linked product, which is linked to insurance. Okay. So my final topic is on hedge funds. You may be wondering why I'm leaving structured products hanging here, but that's because I think there will be some panel questions afterwards. And also, you are more than welcome to grill me on any questions you have on structured investment products. Now, the third and final presentation here is on hedge funds. Basically, there's been a lot of hoo-ha, okay, on this segment of the asset class, especially in Q4 last year when everything tumbled. Okay, I just want to draw attention to the various categories of hedge funds. People tend to lump hedge funds together as one, but in actual fact, there are 5 categories. The first is global macro. Okay, this is because they utilize every instrument available in almost every market, and it can be based on forex, currency play. It can be based on trend, controlling or not. It can be based on commodities. So these are global macro hedge funds. Then you have got the arbitrage or relative value hedge funds, which actually exploit pricing inefficiencies between different asset classes, and or between different markets. The third category is, of course, event-driven. If you think that there's going to be a bankruptcy, you might take a short position, or if you think that there's going to be an M&A, mergers and acquisition event, you might buy